It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is the Mayor of Beckerville, the Honorable Michael Becker.
Hey, Paul.
And when we talk about that, we joke around, but it really is almost like you're running a small city. Because if you own like 5,200 doors like Michael has, 2 people per door, 10,000 plus people. You kind of have to understand what it takes to run a small city. How much carpet do you need? How much tile for the bathrooms? How much roofing you need? All the employees. It is a job.
It's like adult daycare, really. That's what it is a lot of times.
So Michael has done over $500 million in apartment transactions that him and his investors have purchased. $300 million in non-recourse commercial debt. And now we're getting towards tax season, and you guys are up to your eyeballs in K1s.
Yeah, I think we're going to do about a little bit over 500 K1s, so it's a lot.
Unbelievable. And then don't forget, the Ask Mike Mondays are only available if you ask a question. And we get a lot of questions on a weekly basis, but we encourage you to go to the Old Capital Podcast and ask your question. Send us an email on that one. And then we'll try to get it on to the next Ask Mike Monday so you know what's going on. So we love getting questions from you concerning how to own apartment buildings. So buying apartment buildings is great, but there comes with some risks too. So the question for this week is, Mike, what are the biggest mistakes in doing a transaction? Yeah,
so I'll kind of focus this on a lot of the newer investors. So either you've never done a transaction doing your first, or you've done one or two, and you sort of relatively inexperienced. Some of the biggest mistakes that I see, kind of especially getting started, a lot of people really kind of focus on like all the minutia and how do you do this really more than why. What I mean by that is a lot of people get really paralyzed by, needing to know every little thing about how these deals get put together. So, we're big proponents of education and making sure that you understand, how to do this correctly. But, you're never going to know everything you need to know when you get into these deals. And you need to eventually just kind of know enough to be there, rely on your team members and actually go do it. A lot of people just get paralysis by analysis and they just never actually go take action. It's important to get educated, but at some point you're going to actually have to go out and pull the trigger on something. In real estate in general, I do see a lot of people that are, into apartments today, and then they're going to do mobile home housing tomorrow, and then go buy a retail strip center, and then do development of self-storage. And so they kind of lack a lot of focus. A lot of people, if you do a little bit of everything, you're never going to do anything well. So I think really the power of focus is helpful and critical when you do these deals. So if you come talk to me, I buy Class B apartments in DFW and suburban markets that are 200 plus units and that are 10% or below market rents. And then we come in and do like a light value add program. So I have a very specific target for what I go out and do. And the marketplace knows what I want. All the brokers know what I want. And I do the same thing over and over and over again. So I feel like I have the ability of focus and really not making mistakes by shifting from apartments to mobile home parks to self-storage to whatever. So I just do one thing, I do it well. So I think the most successful people I have seen have focused on one thing. And the old saying I've heard is riches are in niches. So let's find your one thing, do it well. And I think you become, the master of that. So that would be another thing that I see. Another thing that I see people do it is a lot of people kind of go alone, right? So we always talk about real estate investing as a team sport. It's about having team members. If you try to do everything yourself, you're never going to be able to scale and be super successful because you're focusing on doing everything instead of just focusing on what you do well and then outsourcing some of the other critical things. So a lot of people try to do self-management, which, some people can be very successful at. And a lot of people just get bogged down in all the HR and unit turnover and all the minutia about it. When if for, 3 to 5% of the revenue, you could pay a third-party management company to go out and do it for you. And then you can then go focus on doing, more and more deals. So making sure that, you have the right team in place. We always talk about property management is probably the most important. Second most important, in my opinion, is having a good, competent commercial mortgage broker to make sure they can deliver the best execution on the debt, as well as, increase the certainty of execution as well, especially when you have, multiple hundreds of thousands of dollars at risk of earnest money and pursuit costs. You need to make sure you get home on your loan with a good product. So having a good commercial mortgage broker in place is critical. You don't need to go shop 20 banks. Have, a company like Old Capital go do that for you. Another thing that I see people get in trouble really is violate SEC law. So there's a lot of intricate stuff. We had the Old Capital Conference, and a day after we had the Old Capital Conference, we sponsored Gene Trowbridge, one of the leading apartment syndication attorneys, or leading syndication attorneys, SEC lawyers out there, come speak and give, a 4 or 5 hour presentation on how the basics of putting these deals together. So making sure you understand how these deals get together. Don't cheap out. Hire a good, competent securities attorney to put these deals together, because one little mistake that you don't know, you're not intending to do it, could derail you and get you a nice nasty letter from the SEC, which I'm sure would be pretty scary if that ever happened. And then, finally, one of the things I see for people that have done a couple of deals the last, 4 or 5 years, been, the golden age of apartment ownership, as I like to say it. Everything's gone up. Everyone's done well. In my opinion, I'm sure Paul shares the same thing. We've seen a lot of people buy some questionable deals at the time and questionable locations, and they come in, they double their money 2 years, 3 years down the road. So I feel like kind of have almost a Midas touch, like anything they do is going to be successful. And so they kind of make similar mistakes. And at some point, the music's going to stop or at least slow up. So making sure you're not resting on your laurels, you're constantly trying to challenge yourself, reevaluate the deals that you've done, and learn from your mistakes and take it and be, better on the next deal that you do. And make sure you have sound principles when you're out there looking at these deals. You listen to some past podcasts I pound the table about the common mistakes that I see people make, buying in the hood, things like that. So eventually it's going to come catch up with you. So make sure that, just because you made a bunch of money doesn't necessarily mean that it was because you did a good deal. The market just could have bailed you out. And at some point, real estate's cyclical. There's going to be a cycle down, and making sure that you're buying good quality deals and you're setting your structure of your deal up right on the front end. Those, and making sure you have the proper debt in place to weather some storms. Those are some key critical things that if you do those, you should be able to be a long-term successful syndicator throughout cycles, throughout many years.
Yeah, talking about the first thing you mentioned was education. There's people that don't invest in education and think that they can do this all by themselves. Well, because they've read a book or they've gone online and looked at a bunch of videos. It really takes somebody to handhold and kind of talk with the people in these groups to kind of figure out what works and what doesn't work in your specific area. So make sure if you can, find an educator, a mentor, and then one that has kind of an ecosystem that can help you put money into these transactions. Again, not everybody wants to own and control a multifamily property, but a lot of the older folks just want to have a rate of return on their money, so they're willing to put $100,000 in or $200,000, but they've gone to these educational places to kind of understand how not to get screwed in these transactions. They don't want to do it themselves, but they want to have somebody else do it, but they just want to invest. Make sure your educational mentoring group has an ecosystem that allows people to do it. The other thing I was going to is what Mike was saying is, there's a lot of money on the sidelines these days. And a lot of people are pressing their luck by investing in areas that 7, 8, 10, even 15 years ago, you would not put money into those areas. But why are you doing it today? It's just because you think that everything you put money into is going to go up. That's not the case. Make sure you understand. Go take a look at some of the reports. Like there was a property that one of the lenders came to me and asked me. They were not doing a loan I was not doing a loan with them, but they came to me and asked me what I thought about the property. I really shut it down. I said, in the last 10 years, that property has been foreclosed upon twice. Not once, but twice. So is it a bad property? Probably not a bad property, but a bad area that property is around. So you can change a little bit of the property, but you have difficulties changing the submarket or the tenants that are going to flow into that property. So, I don't ever want to see anybody lose any money, but make sure you go on to maybe the appraisal district websites or some of the information that you can find out how these properties have done. If you've seen them have been in foreclosure 7, 10 years ago, just be aware that what you see on the surface may have some problems in the past.
Yeah, and it's like this in DFW, and I'm sure it's like in most major metropolitan areas around the country. I mean, all these cities are full. All these apartments are full. even the bad properties are full right now. But when the music stops or slows, the lower socioeconomic areas tend to have the biggest problems first. So those are the areas that are likely to be the most affected. But just because now, there's a property in a questionable part of Tarrant County that recently sold that, was struggling to get to, was always in the 70s and 80% occupancy, and it finally got to, the low 90s within the last year. And it's like, well, heck, if it took you 6 years to recover to the low 90s in the best apartment market we've ever seen in our entire lives, what's it going to be like once you hit a soft patch? So there's something just structurally wrong with that location or that asset or some combination of them. So those are the properties that I'm starting to see some people go out and buy. And I'm just nervous for those properties. I mean, we've seen parts of Lake Highlands, to be granular here locally, that these properties were trading for 10 and 12,000 a door that now are trading for 80,000 a unit 6 years later. And I'm just sitting here looking back saying, how the hell is this even possible? And
now, rents have gone up in that area.
Rents have gone up, but there's still a ton of units and ton of supply. And that's my personal opinion. It's just, point is, be careful what you're buying. Make sure you understand the story of the location and the area, that, just because it's gone up now, if you have, 2,000 apartment units within a 1 square mile radius of your apartment, there's going to be competition and supply. When the market softens, your competitor is going to slash their rents, give concessions, potentially let in some bad element that's adjacent to your property, and then can cause a ripple effect through the entire submarket. So just be careful when you're looking at deals, that you understand what you're getting into. I'm not saying you shouldn't do it. Just make sure you understand why you're getting into it and what the history of that location is 10 years ago, 20 years ago as well.
That's right. And the last thing, I'll put a little bow tie on this. So the people who have invested in apartments, whether it's been the lead, the KP, the deal sponsor, or even limited partners, they've made a ton of money for the last, say, 7 to 10 years in apartments. And then, they've had a property management company that's been making 3.5% to 4% of size in these deals. But Mike, do you know who's going to be the richest person if we have a softness in the economy?
The management company.
That's right. So the management company is going to have to save your ass. That if you bought a property in the hood, or you bought a property that you probably shouldn't have done, so they're not going to charge 3.5% to 4%. They're going to charge 5%, 6%, 7%, because they're going to try to save your ass from having any additional problems. So I'm a big believer of kind of looking in the past to kind of figure out if this was a good area or a bad area 10 years ago, to kind of judge what it's going to be in the future. So again, the highest paid people in the next cycle downturn will be the management companies that kind of save these investors money from going south.
Yeah, it's been a phenomenal run. I don't see anything that's obvious on the horizon that's going to cause a massive correction, but at the same time, you just need to be cognizant of where the properties were in the past, where they've come. And there's a lot of cases in whatever submarket, there's a good reason why, because some big major employer came in, or, whatever happened that kind of changed the submarket. But in a lot of cases, it's just because there's so much money sloshing around that, to use another local analogy, a lot of people are treating South Dallas like a South Irving. And if you're local, those are two very different submarkets. South Irving's, they look similar from afar. They're, they got lower class, C-class, older apartment complexes in both places, but there's actual employment and low crime in South Irving, where South Dallas doesn't have near the employment base. There's much higher crime historically down there. So when the stuff softens, both places are full, but both will soften. But I think it's the degree of the softening will be much less in a place like South Irving than it would be in, say, South Dallas. So just be careful, know your history, get experienced team members. That's one good thing about working, say, like with Paul, I affectionately refer to him as the multifamily Rain Man. He knows where all the bodies are buried, and he can tell you this properties because he's seen it trade over the last 25, 30 years multiple times, because these apartments trade all the time. So knowing a little bit of history about these deals, like I personally wouldn't buy a deal without running it by Paul Peoples, because chances are he knows something about it in his past.
Find the Paul Peoples in your marketplace.
That's right.
So if somebody wanted to know a little bit more about what you do, Michael, you guys buy properties, you have investors. If somebody wanted to kind of figure out and build a relationship with you, what's the best way? Yeah,
the easiest way to reach out to us is simply go to our company's website. It's SPI Advisors. Just go to www.spiadvisory.com. That's SPI like spy advisory.com. There's a contact us form there. If you don't mind, just fill that form out. I'm always happy to try to have a 10 or 15 minute telephone call with listeners of the podcast and see if it could help you out on your own deal if you're potentially interested in working with us. We definitely would appreciate you guys reaching out.
If if you do listen to us, hopefully you are thinking about purchasing an apartment building. And don't forget about the Multifamily 101 white paper report about structuring apartment transactions. If you're thinking about doing, again, as I say, you're bringing the 20 or 25%, and we're bringing the 75 to 80% of the deal. We kind of open our kimono, as they say, and kind of let you kind of understand a little bit about how these deals are structured and what to look for and what to pay attention to when you're putting your thinking together about how this deal is going to get done. Also, too, don't forget to leave us, if you can, go back out into the iTunes or Stitcher, however you got to us, and leave us a 5-star rating. We do appreciate that. And if there's somebody that you think should be listening to us, whether it's in your RIA, your real estate investment club, or that maybe it's your brother-in-law that should be listening about how people invest in apartments, if they're thinking about doing, make sure you pass along the Old Capital podcast to them. We would appreciate that. Michael, anything else?
That's it. We definitely appreciate you guys listening. I was Michael Becker, and I was Paul Peoples. Appreciate you guys listening.
Have a great day. Thank you.